now we're going to do exercise 2-24, and this is on page 109 of your text. So we're going to go to page 109 and look at exercise 24. So here we're going to do some more practice with journal entries and actually posting them to the T accounts. Okay, so here it says open the following 4-column accounts of Teresa Parker, CPA, and they give us cash, accounts receivable, and so on. And I've actually uploaded an Excel file with all of these work problems for you and have them already opened down here. So these will be the T accounts down here. Now, the T account we showed in the PowerPoint slides is a more simplified, it's just this portion of it. But this is an actual 4-column setup. It says, so we have the item, we have our post reference, a debit and credit, and a balance of our debit and credit. That's where we keep up the actual balance. So it's a little more, has a little more to it than just your basic T account. And you need to know this. Sometimes general ledgers and accounts, T accounts are going to look a little different for each company, but it'll look more similar to this, all right? So we're going to journalize the transactions first and then post them to the T accounts, all right? So let's look, it says June 1st, Parker opened an accounting firm by contributing $14,000 cash and office furniture with a fair market value of $5,200 in exchange for capital. So not all the time are we just going to be putting in cash into the business, okay? So sometimes we'll add in other items. So here it was furniture. So these things are going to be coming in at their fair market value, okay? So we added cash to the business, so the business is getting cash, so we're going to debit that. And we gave office furniture. Office furniture is an asset, so we're going to debit office furniture for the value. So we gave $14,000 cash and $1,500, it's not 25, $1,500 in office furniture, okay? And we gave those in exchange for capital. So they're going to get Parker capital in exchange for those assets, okay? And that increases with a credit, and it's going to be the total of those two debits, okay? So our debits and credits still balance. So the debits totaled $19,200 and the credit is $19,200. This is what we call a compound entry. That just means that more than 2 accounts are involved. So that's all it means. So this is an example of a compound entry. Now, this posting reference here, in your book, it has it posting for the account number. So this is where the entry would be posted. So cash is account 110, as it told you to open, and office furniture is 140, and the capital is 310. Now in practice, typically this would say journal entry reference, and this would be like a journal entry number. So this would be journal entry 1. And then when we come down here and post it to the T accounts, that would be our journal entry reference here, so that we would know which journal entry it is and where we could look for supporting documentation, okay? So, but we'll follow it along with what your book is asking you to do right now, and then go from there, okay? So, that was the first transaction. So the second one is June 5th. It said paid monthly rent of $1,500. So we have rent. Rent is an expense. So we're going to debit rent expense, and it's account 520, okay? And for $1,500. And since we're paying it, we're going to credit our cash for $1,500. Okay? Oops. And they didn't ask us to put descriptions here, so we don't have to do that for this problem. All right, so June 9th, it said purchased office supplies on account $900. So we're getting office supplies. Office supplies are an asset. So we're going to debit office supplies for $900, and that account number is 130. And we're buying them on account. So we're not paying cash, so our cash isn't going down, but we're incurring a liability. So we have accounts payable because it says on account. And they said that account number is, let's look over here, 210, $900. All right. Now on June 14th, it said we paid employees' salaries $1,700. Well, salaries are an expense. So we have salaries expense. It's account 510. It's $1,700 and we're paying it. So cash is leaving the company. Cash is leaving the business. All right. Then on June 18th, it said received a bill for utilities to be paid next month. So if we received a bill, we've used up some utilities. So we have a utilities expense, which they told us the account was $530 and it was $250, but we're not paying it yet. We're not going to pay it until next month. So it's not cash, it's a payable. So we have utilities payable, account 210 for $250. Excuse me. All right. Now we've got June 21st. It said paid $700 of the accounts payable created on June 9th. So we had that payable of $900 on June 9th. We're going to pay some of it off now. So we're going to reduce that payable. So we're just going to debit it and reduce the balance. And we're going to pay $700. So debit accounts payable $700. And then reduce our cash by crediting it $700. All right. Then on the 25th, it said we performed accounting services on account. So we performed services on account. That means we've done some kind of service. They said accounting services. We've earned income, but we haven't received the cash. So we would normally debit cash, but since we're receiving it later, we have accounts receivable. All right. Which they said was account number 120 for $5,900. And then credit would be service revenue. Okay. Now the last journal entry transaction is for June 28th. It says Parker withdrew cash of $6,700. So when we have a withdrawal of cash by the owner, we're going to debit our withdrawals, which they said was account 320, $6,700, and then we'll credit cash and 10 for our journal entry. Okay. Now we'll just come in here and we will post these transactions to our T accounts. Okay. So let's do. Let's look at this first transaction here. So it says we've got a debit to cash of $14,000. So I'm going to come down here and find cash on June 1st. I'm going to debit cash for $14,000. Okay. Now in this example, they just have journal entry 10 because it says on the problem that this was for June. Let's see. It says assume the journal entries are recorded on page 10 of the journal. So in this reference down here on the bottom, they're putting in what page number of the journal it's listed on. Okay. However, in real life, these journal entries, some of them are not going to be posted all on the same one. Okay. So assuming this is one big journal entry for the month, if they weren't doing these by item, then we would just put journal entry 10. But if this was an individual journal entry, say it would be journal entry 1, these two might be on a separate journal entry. At the same time, this would be journal entry 2, and so on. Okay. But let's say this is all one big journal entry for the month's activity. So it's going to be journal entry 10. Okay. So we debited $14,000. We'll do the same thing for furniture. So office furniture on June 1st, we're going to debit furniture for $5,200. All right, and it's J10. Okay, and the last thing on there was credit Parker Capital for $19,200. So we're going to go down here, Parker Capital. This is on the June 1st. Credit for $19,200. and we'll do J10. So after that entry, so we'll come back up here to cash. After this entry, we have a running balance in our cash account of $14,000. Okay, so we can do that for each of these to keep up a running balance of our account. So we have a credit 19,200. We'll do the same thing for the entry on June 5th. So we're going to debit rent expense. We're going to come down here, find our rent expense. Journal entry 10. We're going to debit that for $1,500. So we have a debit balance $1,500. And then our credit was to cash. See, credit cash. We're going down here and credit cash. $1,500. So now our balance in here is going to be the difference between that debit less our credit. So now we have a debit balance of $12,500. Okay, I know it's a debit balance because now cash is an asset. So assets increase with a debit. So this increases our cash and a credit decreases it. So we started off with 14,000 debit. When we reduce it by 1,500, we still have 12,500 as a debit. Okay. So now let's look at the third journal entry we had up here. It says debit office supplies and credit accounts payable for $900. So we're going to debit office supplies. And then credit our accounts payable, $900. Okay. Then we've got salaries expense. We debit that and then credit cash for $1,700. So we'll find our salaries expense. And we're going to debit that $1,700. And then we'll come back up here to cash and we're going to credit it $1,700. So after we credit it $1,700 again, we're going to take $12,500, then less $1,700 gives us $10,800. Okay. So then the next journal entry, we're going to debit utility expense and credit utilities payable for $250. So we'll find utilities expense. And the item here, that would be an additional description if we needed it for anything. But we'll debit $250. And we'll go to utilities payable. We're going to credit it for $250. All right. Then the next entry we had was debit to accounts payable and a credit to cash. So we're going to debit accounts payable, $700. So now accounts payable has a normal credit balance. So when we credit accounts payable, that increases it. So when we debit it, it reduces it. So now that leaves us with a $200 balance in our accounts payable. Okay. All right. And then we credited cash for $700. And it leaves us with $10,100 in there. Okay, the last thing was over here, we're going to have accounts receivable, debit, $5,900, and credit service revenue, $5,900. So I'm going to go to accounts receivable, debit at $5,900, and go to service revenue, $5,900 credit. Okay, that leaves us with one more journal entry. So we debit withdrawals, $6,700, and credit our cash. So I'm going to go ahead and credit cash, $6,700. So now we got a $3,400 balance, and then we're going to do withdrawals. It was a debit. All right, so now our T accounts, these individual account activities, are all updated. So then we'll go through and we're going to take each of these balances and put them on our trial balance, right? So for cash, it says it's $3,400. So I've got down here, I've got my trial balance. Anytime we do a trial balance, it's going to have the name of the company, the statement saying trial balance, and the date we're preparing it. And we'll list our account numbers here. All right. And then we'll put the account name and list the debit or credit balance. Okay. So we've got on the first one, we had up there, it was account 110 was cash, and it had a debit balance at $3,400. Okay. The next account was accounts receivable, has a debit balance of $5,900. Okay. So we do the same thing, 120. Accounts receivable, $5,900, and this is just listed in account order, okay? So 130 was office supplies. We ended up with 900. You come up here, 900, 5,900 for office furniture. And then accounts payable, that was the last asset. Remember, we paid it down to $200 credit. Okay, so come up here, you'll see accounts payable. It's a credit balance of $200. And then we'll have 220 was utilities payable. It's a credit of $250. We've got Parker Capital. It's a balance of $19,200. So we go up here, so capital $19,200. Withdrawals of $6,700. Okay. Then we're on to service revenue. So service revenue, we ended up having a credit of $5,900. And then we'll list our expenses. So 510 was salaries expense. 520. And then 530 was our utilities expense. And that was for $250. Okay, then we'll have up our total. And we're going to total up all of our credits, debits, and our credits and make sure that they agree. Because if they don't agree, then we're missing something. So we do agree, so we're in balance. And now we could use this to create our financial statements. All right, so if you have any questions on this, please post them to the Chapter 2 discussion questions or send me an email. Okay.